Every nation on Earth is carrying a debt load. The US alone is north of $38 trillion, a record high. The European Union owes around $14 trillion. Japan, something like $9 trillion. Even oil-rich Saudi Arabia, or exporting powerhouses like Germany and China, are on the hook for colossal sums. So here's the million-dollar question. If everyone's in the red, who exactly is holding all the IOUs? Welcome to the realm of financial history, where money, power, and the past collide, and nothing's quite as simple as it seems. Debt isn't just a burden. It's the very scaffolding of the modern world. Every conflict, every economic boom or bust hangs on this invisible framework of financial obligations. And if you follow the trail of creditors far enough, you stumble on a pretty unsettling truth. The world doesn't owe its dues to a specific individual or nation. It owes it to itself, but that doesn't mean everyone's profiting equally. To grasp how we ended up here, a planet drowning in over $315 trillion of total debt, nearly 3 times the size of the entire global economy, we need to rewind to the starting point. Centuries before the first credit card or digital transfer, the idea of national debt wasn't hatched on Wall Street, but in the crucible of war. Back in 1694, England was slugging it out with France, and its gold reserves were dwindling fast. The king turned to a group of merchants for help. In exchange for a steady stream of interest payments, guaranteed by future taxes, they bankrolled the crown. To manage this new arrangement, the Bank of England was born. It was a game changer. Suddenly, the state could spend money it didn't actually have yet, and the lenders got something incredibly valuable in return: a government promise that could be traded, bought, and sold. This was the dawn of the government bond, the genesis of today's financial system. France quickly followed suit. The Dutch perfected it. The newly independent United States used it to finance their revolution and later, their expansion. Sovereign debt went from being a sign of bankruptcy to a measure of creditworthiness. The ability to borrow was the ability to govern. Empires used to conquer lands to grab gold. Now they issued bonds to garner interest. The battlefield became a balance sheet. Fast forward 3 centuries, and debt has become the world's top export. The US is swimming in $38 trillion of it. Japan is above $9 trillion. And global borrowing swells by the equivalent of $1 trillion every 100 days. Every nation is a debtor. Every bank is a creditor. And every citizen, through their taxes, savings, and pension funds, is both. But who exactly is on the hook at the other end of the line? Let's start with the US, because its debt isn't just domestic, it's universal. Of that $38 trillion, about half is in public hands, meaning it's owed to outside investors, not other government entities. Roughly 2/3 of those investors are domestic institutions: American banks, pension funds, mutual funds, insurance companies, and the Federal Reserve itself. The remaining third, about $9 trillion, is held overseas. Japan stands out as the biggest holder, with roughly $1 trillion, followed by China, with around $800 billion. Then come the UK, Luxembourg, and Belgium. So when you hear that the US is in debt to China, it's true, but it's only about 2% of the total. The bulk of American debt is owed to America itself. The Treasury issues the bonds. Banks and funds buy them up. The Federal Reserve often buys them back, creating new dollars in the process. American citizens pay taxes that cover the interest on those bonds, and that money flows back into American retirement accounts. It's a closed loop. The debt is real, but the creditor is, in large part, a reflection of the same system. And that cyclical nature isn't unique to America, it's worldwide. Japan lends to the US via Treasury bonds. The US lends to Europe via the IMF. Europe funds developing nations through the World Bank. In turn, developing nations lend back to the advanced economies by parking foreign exchange reserves and Western securities. It's a planetary game of hot potato. Except the potato is made of promises. Every country holds another's IOU. Every promise is backed by another promise. It's like a poker table where everyone's borrowed chips from each other, and the only rule holding the game together is that nobody can cash out. But there's a fourth dimension, the most powerful of all: the markets themselves. Behind every government bond is a complex web of institutions: hedge funds, pension funds, sovereign wealth funds, and central banks managing tens of trillions in assets. They are the real judges of credit. They determine which nations get cheap loans and which will pay a steep price to survive. If they lose faith, currencies plummet, governments fall, and entire economies can be reshaped in a matter of hours. Democracy elects who governs. The markets decide who endures. And the chief regulator of this market, the modern high priest of the system, is the central bank. Central banks don't just control debt, they create it. Whenever the Federal Reserve or the European Central Bank buys government bonds, they generate new money in exchange. A liability on one balance sheet becomes an asset on another. Every dollar in circulation represents a unit of debt somewhere else. There is no money without debt. On every coin, on every bill, on every digital dollar, there's a promise to pay, invisibly printed on its surface. For many decades, this cycle has been sustained by confidence. As long as investors believe that governments will make their interest payments, even if they never repay the principal, the machine keeps humming. But what happens when confidence crumbles? We've seen it before. In Greece in 2010, government debt became unsustainable. Bondholders panicked. Yields skyrocketed. The European Central Bank and the IMF stepped in, but the bailout came with austerity, tax hikes, spending cuts, and widespread unemployment. For an entire generation, financial rescue became synonymous with sacrifice. In Argentina, successive defaults have turned debt into a national curse. In Sri Lanka, fuel shortages and political collapse came when the government ran out of foreign currency to service its loans. When the system breaks down, the creditors suddenly become visible. The IMF, the rating agencies, the anonymous bondholders who wield control over entire nations. And yet, even after the collapse, the same logic restarts. New loans replace old ones. Old debts are restructured. The machine sputters back to life with a new denomination on the same balance sheet. That's because, in the 21st century, debt wasn't designed to be repaid. It was designed to be rolled over. Current governments have no real intention of paying off their debts. Not now, not ever. That's not a secret. It's political practice. When you or I take out a loan, we're expected to pay back the principal. But governments operate differently. They treat debt as an ongoing subscription, issuing new bonds to pay off old ones, in a process economists call rolling over. The interest becomes the real product, the rent charged for stability. The global economy today depends on this rent. It's like a shark that needs to keep swimming to breathe. The global financial system runs on faith, not repayment. The United States will never liquidate its $38 trillion debt. It will refinance it perpetually. Japan has been rolling over its debt for decades, and it now exceeds 250% of GDP. And yet, its government bond yields remain near zero. Investors aren't waiting for repayment. They're waiting for the renewal of the agreement. Why? Because to them, government debt is the safest guarantee there is. A U.S. Treasury bond isn't viewed as a liability. It's an asset, the foundation of global markets. Pension funds own it. Banks use it as collateral. Central banks treat it as cash. The system relies on the fact that governments will never pay off their debts, because if they did, the world would lose its most trusted financial instrument. Imagine if Washington somehow decided to pay off every penny of its debt. Banks and funds around the world would suddenly lose their most stable asset. The supply of dollars would shrink dramatically, triggering deflation and a collapse. Paying off the debt would destroy the very thing that allows the economy to function. So, governments do the opposite. They keep issuing more, not irresponsibly, but rhythmically. Debt becomes a kind of heartbeat of capitalism itself, reverberating through every pension, mortgage, and market on the planet. And that's why when politicians talk about balancing the budget or eliminating the national debt, they're peddling a false promise. The goal isn't to extinguish the debt. It's to keep it sustainable, manageable, and attractive enough that the system continues to have faith in it. Because the moment that belief vanishes, the numbers lose their value. Confidence crumbles. Interest rates spike, and the economy, built entirely on continuous promises, grinds to a halt. That's the real secret of sovereign debt. The plan was never to pay it back. The plan is to make the world believe it will be. It's a closed loop of confidence. And as long as that confidence holds, the numbers can grow without limit. But confidence isn't distributed evenly. When we say that debt is owed to ourselves, that's only half the story. The interest payments don't flow equally through society. They flow upwards, transferred from taxpayers and workers to the institutions and investors who hold the debt. In other words, debt isn't just a transaction between nations. It's a transfer between social classes. That's why global inequality and global indebtedness amplify each other simultaneously. The system benefits those who own the debt and penalizes those who only pay for it. If that sounds familiar, it's because it's the same story writ large. From households to nations, from nations to the planet, the creditors aren't villains. The debtors aren't victims. They're two sides of the same machine. The problem arises when the machine runs out of fuel. When new borrowing can't honor the promises made earlier. That's when the question, who is the creditor, stops being abstract and becomes personal. Because at the apex of this global pyramid, there isn't a single entity to blame. It's not China. It's not Wall Street. It's not the IMF. It's all of them, and us. The modern financial system has turned debt itself into money. Governments issue it, banks multiply it, investors trade it, and citizens depend on it. The line between debtor and creditor has blurred beyond recognition. Debt once meant servitude. Today, it means equilibrium. But if that equilibrium is ever broken, if the confidence unravels, the illusion will end, and we'll remember what debt really is, a promise that can't be kept forever. If that gave you a new perspective, hit subscribe. History holds the answers. I'll show you where to find them.